Hey, what is up everyone? It's David here. As much as I want to talk about Elon hosting the SNL with tons of skits around Dogecoin and even a surprising one around Wario, I wanted to talk about something that happened last week I haven't had time to cover yet, and that's the Fed's warning towards elevated asset prices. The Federal Reserve, which is the equivalent of Australia's RBA, have said that asset prices are getting so elevated that if market sentiment changes, we might just have a significant decline in asset prices on our hands. In this video, I want to talk about what that means for investors like me and you, and there's a few changes I made to my portfolio as well, so I want to share my learnings with you. As usual, this video is not financial advice, it's just general information for entertainment purposes. So what exactly is the Fed warning us about? Now, this CNBC article is actually a summary of the financial stability report that came out of the Federal Reserve recently. This is a great read for anyone who's interested. I'll leave a link in the description box below. Now, for the purpose of this video, I'm just going to cover the things that I think are most relevant to me and you. So as we scroll down the CNBC article, there's a key quote here that I want to read it out to you. High asset prices in part reflect the continued low level of treasury yields. However, valuation for some assets are elevated relative to historical norms, even when using measures that account for treasury yields. What the Fed is warning us about is that asset prices are already high and it continues to climb. But if market sentiment changes and people no longer want to take risk in equities, we might just see a significant price decline when it comes to asset prices. Now, for me personally, I don't want to overanalyze this and go, holy crap, the Fed is saying that the market is overvalued, and if the sentiment changes, we are going to have a market crash. We don't know when the sentiment will change. And we also have no idea whether the market is going to go up, down, or sideways tomorrow. No one knows. But I am a believer that it's not a stock market, but it's a market of stocks. Sure, there are definitely companies that are highly valued and at some point even overvalued, but it doesn't mean that there are no opportunities in the market. Let's look at some numbers to get some perspective. So let's take S&P 500 as an example. From the bottom of the pandemic crash, the index have generated approximately 84% returns over a year and a bit. That's a lot of return in a very short amount of time. So if we take a look at the forward PE for S&P 500, now forward PE is the current price divided by future earnings. It's just a way to gauge valuation, right? The median, the historical median for the forward PE is a little bit above 15. Now you can see that the current forward PE is around 23, which is much higher than the historical median. And the last time it was this high, it was during the dot-com era. So what the Fed is more worried about is that if the valuation continues to climb and earnings wasn't as good as expected or the market sentiment changes, then the reversion back to median will be pretty big, right? So imagine going from 27 to around 18 to 15, that kind of market correction will be pretty massive. And for investors like me and you, higher valuations just means that our future expected returns won't be as high. Because ultimately, if valuations are already really high, earnings has to go up to match the valuation. Otherwise, the price will have to decline to come back to the true level of earnings. Now, there's one more table I want to highlight that I think is really important to at least be aware of. If we take a look at this table from the Financial Stability Report, this is the size of selected asset markets. These are the different asset classes, and we're looking at the difference between the average annual growth rate versus the pandemic growth rate. Now you can read this table yourself. There's two things I want to highlight from this table. If we look at the equities market, over a long period of time, it has generally grown at around 9.2%. But from the pandemic period, which is basically 2019 Q4 to 2020 Q4, the equities market have grown by 22%, which is massive. The other thing I also want to highlight is that if we look at high yield and unrated corporate bonds, high yield generally means higher risk, and corporate bonds is basically corporate debt. In the pandemic period, it has grown by 25%. So that means there are a lot more high yield, higher risk corporate bonds that's flying around in the market currently. What the Fed is trying to say is that asset prices is already really high, taking into account low interest rates. If it goes any higher, if market sentiment changes, then the crash back down to reality is going to hurt. I think that's fairly reasonable. Now, in saying that, valuations are justified right now because interest rates are low. And as long as the earnings can catch up to that valuation, I think we'll be okay. As it stands, there's a broader belief that the reopening plus the vaccination will basically push earnings all the way up. And I think from our perspective, I'm definitely on more of the optimistic side, just because the earnings upgrade is supported by stimulus and also the massive infrastructure spending coming from the US. But I am also very cautious because things don't always pan out the way we expect it to be. And because valuation is so high at the moment, it doesn't mean that I'm going to stop investing. It just means that I'll spend a little bit more time looking at individual opportunities. Now, when it comes to individual opportunities, I am challenging myself to look at sectors outside of something that I'm normally comfortable with. So I've been looking in the healthcare industry, and the new research positions I've added into my portfolio are within that industry. So I want to share some of my learnings with you, and plus to do a portfolio update as well. So when it comes to my CMC market portfolio side of things, which is my Australian portfolio, it's worth about 94,000 Australian dollars at the moment. I've made no changes on this side, so everything is still exactly the same. For my stake portfolio, this is where I made most of my changes, and altogether, including buying power and unsettled funds, it's about 40,000 US dollars. I just want to quickly jump in here. Unsettled funds is actually already included in the buying power, so my US portfolio is actually around 37,000 US dollars, just to clear things up. And by the way, I'm not sponsored, but if you do want to try stake for yourself, I'll leave a link in the description box below. Now, the main changes I did make on this side of the portfolio is that I had a limit loss on Zoom and it got triggered at 292. And the reason why I had a limit loss on Zoom is because one, I wasn't sure what the downside risks actually could be because they were a massive pandemic winner. Not to mention, early in the year, I didn't have limit loss on some of my positions and I'm just learning from my mistake. So this is me managing my downside risk and it's still on my watch list. I'll probably come back to this in the future. Now, the major changes I did make to my US portfolio is I added a research position in Bristol Myers and also in CVS. Now, the main reason for doing this is that I just want to incentivize myself to learn more about the industry. And if I don't have skin in the game, I find myself getting lazy and not really learn more about it, right? I'll talk more about the reason for these two in just a second. And I've also added an ETF that tracks the copper miners in the world. Now, the thesis for having copper exposure is we're all probably talking about the price action of copper just shooting through the roof. But more importantly, copper is a key material that's necessary in the electrification tailwind. You need copper for your solar panels. You need copper for your electric vehicles. And in saying that, even though the price action has been really sharp on the upside for copper, we stretched the timeline a little bit. We can see that the last bull market, or at least a way to gauge upside, is that from 2011 to 2012 there was a massive bull run for copper, and since then it's just been not going anywhere, to be honest. Or you can almost say this will be a bear market, moving up towards a bull market. Now, in saying that, it's very likely that because the price action is so sharp on the upside, it'll probably correct, and then we'll see what happens from here. But the main reason for at least having this ETF in my portfolio is just to get exposure to a key ingredient for the electrification process. Now, when it comes to Bristol Myers, let's look at some financials. Now, one of the main reasons I have came across this is I was looking for value stocks because I have a bit too much growth exposure. I wanted to have some individual value stocks that I could practice on, essentially practice my stock selecting skills and see how I go, right? So this is and then Bristol Myers came out of my filter. And one of the main things I'm really looking for, especially for value stocks, is that I want to see revenue growth. I want to see growing EBITDA, and I want to see a lot of free cash flow. Because this is an established company, right? For growth companies, you might not see a lot of earnings, but for value companies, you want to see earnings. Now, the cool thing about Bristol Myers is that, from this period, Bristol Myers was actually on a declining spree. And this is the period when the new CEO came in. Now, the new CEO actually is a physician by training. So he's actually a doctor, whereas the previous CEO, as a chairman now, was a business person. And this is very similar to the situation in Intel before, where you had a business person leading an engineering-led company. So you would definitely want, someone with relevant experience all the way at the top. Now that that is the case, I feel a lot more comfortable. And you can see that, from 2015 onwards, the revenue has been growing tremendously. And this massive jump here is when they acquired a company called Celgene. Now, the good thing is that when we look at the growth rate, now when we look at revenue growth on a year-on-year basis, since 2015, it has grown quite tremendously. And I'm really happy about that. But more importantly, when you look at EBITDA growth, you can see that when revenue grew by 7.8%, EBITDA grew by 11.3%, which means that there is margin expansion for their products, which is great to see. And when it comes to free cash flow, we'll just skip down a little bit. You can see that they have grown their free cash flow over this period by 13.7%. Now, this is quite a long time horizon. So about from 2010 to about 2022, which are estimate numbers. So free cash flow is really strong in my opinion. So given that I'm happy with the leadership, I'm happy with the revenue growth and EBITDA and free cash flow, one of the last piece of the puzzle is to look at valuation. So when we go to valuation, I have actually charted the next 12-month EV EBITDA for Abbey, Pfizer, and Merck. These are some of the more closest comparable companies to Bristol Myers. And you can see that the blue line is Bristol Myers, and the orange, green, and black lines are Merck, Pfizer, and Abbey. Now, the first impression shouldn't be, oh my gosh, Bristol Myers is undervalued. When a stock is that far away from the peers, the first question we have to ask is, where is this discount coming from? Obviously, the market isn't stupid. They are discounting the stock for a reason. And it turns out that there is two lawsuits looming over Bristol Myers at the moment. One is with the IRS, with basically paying more taxes. And another one is complications with the Celgene acquisition. I personally have looked into it. I don't think both are big deals. It will probably cost some money to Bristol Myers, but they have more than enough cash to cover it. So I have looked into it, so not too stressed about it. Now, if we go to the competitors tab, and we'll look at the actual numbers. Now, Bristol Myers, if we look at a next 12-month EV EBITDA, it's currently trading at around 6.57 times, right? We'll compare that with its competitors. The mean EV EBITDA amongst the competitors or the peers is around 11 times. So there's quite a bit of upside to be realized. And similarly, the gap is even bigger for the PE ratio for Bristol Myers versus the average PE for its peers as well. Now, of course, it seems like there is upside to be realized, but at the same time, I'm still learning more about this, so I'll keep you posted on my learnings. Now, when it comes to CVS, it's similar logic in the sense that I wanted more value stocks and I wanted to practice my stock selecting skills. Basically, I'm trying to refine my process down to a point where it's repeatable, it's consistent. So I'm just learning, I'm practicing. And CVS, came up on my filter. So if we look at revenues, again, with value companies, I'd love to see revenue, EBITDA growth, and free cash flow, right? But in saying that, CVS is not a high margin business, and there is quite a bit of retail footprint as well, right? But not as much as Walgreens. So these are US pharmacies. And if we look at the revenue, it has grown by about 10%, over the last 11 years, which is okay. It's not a growth company, so don't expect like Facebook or Apple type growth, right? And also just to point out, CVS actually acquired a company in 2019 called Aetna, which is a health insurance company. That's why you see a pretty big jump over here. Now, when it comes to revenue growth, it has grown about 9.7% over the last 10 to 11 years. Not amazing because we are really not expecting like Facebook or Apple type growth over here. EBITDA has also grown as well, but not as much as revenue. So you can see that because the EBITDA growth is not as high, if not higher than revenue, we can kind of make a simple assumption here that margin expansion didn't quite happen. In terms of free cash flow, if we just scroll down a little bit, we can see that they are generating tons of free cash flow, which is great. So they're converting a lot of their earnings into free cash flow, which is really, really good to see. So in saying that, the next piece of the puzzle is look at valuation. And one of the easiest way to look at valuation is go to the valuation tab, go to competitors. So these are insurance companies, and Cigna is another one that I'm actually looking at the moment. So if we look at CVS next 12-month EV/EBITDA, it's about 10 times. So it's kind of right on the mean. There's a little bit of upside when it's compared to the average EV/EBITDA, but when we compare to the price of earnings, there's quite a big gap. So there is upside when it comes to CVS, but it's also very risky because CVS business, pharmacies and also health insurance, very prone to regulation interventions, right? But the good thing about CVS when compared to something like Walgreens is that their strategy is trying to basically expand the physical footprint, so as many physical pharmacies as possible. But where CVS has a bit more of a blended approach where they acquire Aetna to have the insurance arm. So they, in my opinion, they have a bigger moat when compared to its peers. And this is one of the reasons why I'm a little bit more interested towards CVS. So again, I'm learning more about the healthcare industry at the moment. So I just want to have some skin in the game to force myself, incentivize myself to learn more about it. I'm having a lot of fun experimenting with my portfolio, learning new things, and I'm trying to figure out a process that's both consistent and repeatable for myself. But if you'd like me to share my screening process with you, let me know in the comment section below. I might just make a full video on that. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.